What if that strong economy that everybody's been bragging about is actually just a house of cards built on broke borrowers? And that subprime bankruptcy of Tricolor wasn't a one-off fluke any more than the shocking collapse of auto giant First Brands. Now stick around, because these cracks in the banking system are screaming warnings of an imminent financial crisis, and ignoring them could wipe out your savings overnight. Because in boom times, bankruptcies are rare. You have the issuance of new debt, and on top of that business hype, all it does is paper over the rot on the balance sheets. But as the economy slows, and this is what we're seeing right now, those cracks start to erupt in the credit markets. And what we're faced with are fewer hours, job cuts, and skyrocketing inflation. And for everyday workers, it means they can't keep up with their payments. And this hits their wallet right where it hurts. You have higher daily costs for groceries, gas, and bills, and that's less money to pay on debt. And right now, Americans are falling behind on their car payments at the highest rate in decades, with repossessions now surging to 1.73 million a year. And for lenders, this spells nothing but disaster. You're faced with rising delinquencies, and then they explode into all-out defaults, and then bankruptcy, well, it follows fast. Now, Wall Street just brushes this off as bad business, or to say, hey, it was fraud, but they're missing the bigger picture. And this is what I try to warn you about. Without endless new money on consumer spending, cash in the financial system starts to dry up, cracks then widen, and a handful of failures snowball into full-blown crisis. Now, they dismissed Tricolor and First Brands, but now another subprime lender, PrimaLend, they just filed for bankruptcy after defaulting on their bonds. And while Wall Street lures you with ultra get-rich dreams of buying stocks at the top, bank stocks are quietly tanking right now, and it's a red flag that this coming slowdown is real. Now stay tuned, because over the next few minutes, I'm going to reveal the exact blueprint to crisis-proof your portfolio before it's too late. Because PrimaLend's bankruptcy reduced focus on subprime consumer strain. Now, this isn't an isolated fraud. It's the American consumer cracking underneath a strong economy that's completely failing them. And we're stuck with stubborn inflation. Workers are facing even less hours, and the unemployment rate, well, even though we don't have the official government data, we know it's creeping higher. Now, Donald Clark, he's the president of asset-based lending consultants, said that lenders have become too complacent about who and what they are financing, as they need to put money to work eclipse concerns about risk. And this is exactly what led up to the global financial crisis. You had too much money from Wall Street chasing loans. Now, when that happens, fraud gets overlooked and lending standards drop. It's not until it happens that Wall Street says, look, it wasn't our problem. They were cheating. Now, lenders like PrimaLend, they're incentivized to lend. But think of this, when the economy slows down, and that's what we're facing right now, it starts to become obvious that some of these companies shouldn't have lent to some of the people they did. But at the time, it made perfect sense. Wall Street was throwing money at them. They needed to put it to work. And as more consumers fall behind, it starts to spiral right out of control. And here's the evidence. According to PrimaLend's website, it advertises itself as a lender. It says yes when others say no to borrowers seeking credit. So you can see the situation that's been created here. Wall Street isn't going to take the blame. They're going to say, look, it's all about the lender. It's about the consumer. But the reality is, this is about a weakening economy, one that's faced with a lot of over-indebtedness. And now we're starting to see the real pain, the real cracks forming. And this is just the beginning. And this is why we're seeing echoes now of 2007 and starting to become louder. Because the general consensus among Wall Street is there won't be another financial crisis. There can't be another crisis. It's not possible. But it's really hard to know how much contagion there will be from some of these clearly frothy headline events. This according to Hunter Hayes, the Chief Investment Officer at Intrepid Capital Management. Because I want you to think back to 2007. There were some red flags that were forming. But in the end of the day, it was the labor market that started to break. And that's the key point here. You first see hours drop, you see consumers fall behind, they enter delinquency, and then they cut their spending, the job market goes. So as demand and consumption fell back in 2007, so too did the need for workers. Now, I want you to see how we put the odds in your favor when it comes to trading. Let's take a look at this trade we put out to our CTA Timer Pro subscribers on the 15th. We told them to buy PHO at the open. And why did we do that? Because based on our new optimized system, It's told us that anytime the signal hits, it has a historical 100% win rate with a 3% average expected return over the following 10 days. So if you can imagine having that level of information, it will change the way you trade, put more money in your pockets. All you have to do, grab those links in the description below, use a coupon code for your free 30-day trial, and stay tuned to the end of the show for more information. And here's the evidence. Let's take a look at this chart of average weekly hours of production of non-supervisory employees against the delinquency rate of all consumer loans in red. And you can see very clearly that as hours worked drop and paychecks shrink, the delinquency rate rises each and every time. And that's the risk we're facing right now, because we can see that hours worked have dropped since 2022. It's plateaued, but based on what we're hearing from workers, it's about to go even lower. And that means the delinquency rate, these one-off notions from Tricolor, First Brands, and now PrimaLend, no, it's a symptom of a brewing crisis. And what we're hearing right now from some of the biggest players in the banking industry, they're saying there's a lot of rot, and far more rot than you can believe. Check this out. Jamie Dimon said back in June he wouldn't be buying credit if he was a fund manager. And Jeffrey Gundlach, he's known as the Bond King and Chief Executive Officer of Double Line Capital, said soon after that his firm had been cutting his exposure to junk bonds because valuations do not reflect the risk. So here's what I want you to understand. If Jamie and Jeffrey are concerned, you should be too. And you need to take a hard look at your portfolio and follow their lead, because what they're saying isn't something they're trying to take advantage of. They're warning you of the risks that they see in the financial system right now. Now, while every cycle is unique, what's happening with these subprime lenders is not a one-off event. It is a red flag. And now we find out today that Eagle Bancorp report a $67.5 million loss in the third quarter of 2025. Now, the company continued to address asset quality challenges within its loan portfolio, particularly in the office segment. Net charge-offs totaled $140.8 million for the quarter compared to $83.9 million in the second quarter. This represented an annual rate of 7.36% of average loans. So what we're seeing here is a slow move as these sour loans go into default, and that means for a lot of banks is what just happened at PrimaLend is coming to the regional banking system. But it all comes right back to the U.S. consumer. They keep falling further and further behind. The economy is not working in their favor. It's not turning around. Because when you see headlines like this, low-income consumers pulling back on restaurant spending may signal trouble ahead. My friends, this is a leading indicator that discretionary spending is going to drop as hours drop, and households, that we see that because they've been continually worried about their finances. There was a brief point when they were optimistic, but the economy continued to move in the opposite direction. Now, analysts from Goldman, led by Christine Chow, revealed her team's survey of 2,000 consumers, and that pointed to a softening restaurant spending intentions, especially among lower-income households. She said that nearly half of consumers earning under $90,000 plan to dine out less over the next 3 months. So what we're facing here is eating out has become a luxury, even for fast food. The prices are becoming ridiculous. And so it's easy for consumers to cut back on eating out. But that's not the only thing that Goldman said they're cutting back on. We're finding out they're cutting on subscriptions, driving, travel, movies, fast food, clothing, and you name it. Everything is on the chopping block. So what Wall Street and investors can't see right now, because they want to keep buying high and even hoping the market's going to go higher, banking pros like Jamie Dimon and Jeffrey Gundlach are saying, look, there's real issues here in the banking system and it's not being resolved. And as demand slows and hours work continue to get cut, what you're going to see is confidence is going to fall, eating out is going to drop, and borrowers are going to keep missing payments. Let's take a look at average weekly hours of production of non-supervisor employees, still shown in blue, against advanced retail sales in red. And you can see that usually what we're facing is retail sales start to peak and start to turn down, and then you see a drop in hours worked. And notably, you tend to see this going into recessions. Now, we saw this happen right before 2015. Of course, we know there was a global slowdown at the time, but look at the risk we're facing right now. Consumers are saying, look, we expect the economy to weaken, meaning they believe their hours are going to drop, and what that's going to translate into is less retail sales. So what started with Tricolor and First Brands wasn't an isolated incident. The same rot, a slowing economy led by over-indebted workers getting fewer hours, is now showing up in PrimaLend And my friends, this is just the beginning. But my friends, this isn't doom. This is your wake-up call right now to crisis-proof your portfolio. So here's what I want you to be thinking. Look to rotate out of those banking stocks and into defensive. Build a 6-month emergency fund. If you could slash your high-yield debt, do it. Trade those bonds in the high-yield space for treasuries and add dollars to your portfolios. I'm talking about real ones, not altcoins, because this is your dry powder I want you to have to buy the real dips when they happen. Now, if you follow these tips, you won't just survive the next financial crisis, you're going to come out wealthier than ever. And speaking about being wealthier than ever, we put the odds in your favor when it comes to trading. Let's take a look at that trade on PHO. And what made it so unique was we told our subscribers, based on our optimized data and our full back test, that when it hits this signal, it has a 100% win rate and a 3% expected return over the following 10 days. Now, it hasn't hit that expected return, and it doesn't always hit that. But can you imagine trading with that kind of data? And that's what we give our subscribers, because right now, all of our strategies are fully optimized on a per security basis. This is something nobody's done. And we've taken that data and we give you this win rate and the expected return to put the edge in your favor. And here's the difference. Let's take a look at this optimized back test on symbol SPY. This using our Metre strategy. It generated a 71% total return, beating buy and hold, had a 66% win rate on 69 trades, and a max drawdown of right around 7.5%. Now let's compare this to an unoptimized strategy. This is called the Bravo 9, run by my buddy Jay Bravo. It says you can't even use it by itself. You have to use a bunch of tools and sit in front of your screen. With my strategy, you just take the trade and place it if you want. And check out why. Look at the total return, 51%. Win rate, 51.5% on half the number of trades. Max drawdown, it's the same. So his system versus mine, you can see you don't have the data, you don't have the tools, and your trading success is going to be far worse. Now, this trade on PHO, it came on my CTA Timer Pro report. And what this is designed to do is put you ahead of big machine buying and get you out before they sell. Now, we scan the entire equity, bond, currency, commodity markets each and every day, each symbol fully optimized for trading. And here's the thing, you get the daily report, you get the optimized trading signals, you get my opinion on the best trades, you get full risk control levels, a tracking of all open trades and returns, a weekly update, and here's the best part, you get a 30-day free trial. Now, whether you're new to trading or you're an experienced trader using other systems, our system is designed for swing trading. We're going to get you in and out in around 10 days, and that's the goal. Put more money in your pocket and put the odds in your favor. All you have to do is grab those links in the description below and use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.